Hello, everyone. This is Sebastian McMahon from IA Financial Group. I'm back with another weekly economic review, this time for the week ending June 10, 2022. So let's dive right into the market action this week. So red, and more red. So we are convinced that we are into a long-term bear market, so that we're going to be grinding lower on equities for a while. The last few weeks, we had the bear market rally. So that was an upward move within a bear market. The first bear market rally that we tend to see in every bear market is about 7-8%. So we got something like that. Now it seems that this rally is over and that we're starting to trend lower. So after 4 days, here's the picture. So negative about 2% for the S&P 500, 1% for the TSX this week. But on Friday, we got the very elevated inflation figure from in the US, and that's pushing to more losses. So more on that in a minute. But also bonds were negative on the week. The inflation being still an issue, and the words from central banks, especially in Canada, pushed interest rates higher. Now let's see how interest rates react now if we're starting another downtrend on equities. But it was a pretty bad week, minus 2.5% on the week for long bonds. Oil was higher, and Canadian dollar lower on the week. So if we start maybe with some good news, is that in China, the COVID zero might be behind us, might be in the rear view mirror. So I say might because if you look on the left, you have the number of cases. So it's really getting close to zero now. And they're looking to reopen, and it should support the economy with a lag of between 3 and 9 months, depending on which figure that we look at. When China starts to do better, it tends to help the global economy, but it's not instantaneous. When I say might, is that they are planning to shut down Shanghai again for a few days for mass testing, just mass testing, but that's what they said also in April. And finally, the economy was shut down for a few months. So let's see if we are really putting that in the rearview mirror. Now, if we go to the US, well, inflation is at the 40-year high. So back to the early 1980s this time. So not 30 years, it's now 40 years. And it's at 8.6. So the peak is not yet in. So we're seeing the price of gasoline being still pretty hot, accelerating. It was all over this report in May. We're expecting a hot summer, a tough summer for the price at the pump. So we should have more inflationary pressure coming from that. And now the conundrum that we have is that inflation being so hot, that means one, that the US economy should slow down more because it's eating into spending power of households. So this is not bullish for stocks if we have an economic slowdown or a recession. And two, well, inflation being so high means that the Fed need to hike probably more quickly, or maybe hike stop at a higher level. And this is not bullish for equities. So whatever happens, it's not good for equities. So inflation has a real impact now on the economy and on the stock market. And that brings us to the risks of a recession in the US. So are we already in a technical recession? So technical recession being two consecutive quarters of negative growth in real GDP. So the quantity of goods and goods and services that are traded. Q1 was negative already. We had a negative surprise coming from trade, from exports and imports. Q2, well, on the right, you see the forecast here from the Atlanta Fed, so the Federal Reserve of Atlanta, and it's trending lower, and we're at about 0.9% now. So it doesn't take much of a negative surprise to bring that into negative territory. So the odds that we're already in a technical recession are elevated. Moving to Canada, the picture is much better. Our labor market is doing very well. We're maybe even running against maximum employment now because the unemployment level is at 5.1%, which is the lowest ever, but ever starts in 1976. That's the data that we have from StatsCan. So it's the lowest unemployment rate in 45 years. Wages are starting to accelerate quite a bit, so this suggests that we're running against the limit. The gains were pretty good, but we're seeing mostly gains of we're seeing a rotation from part-time work to full-time work. So businesses are securing their workforce by putting them full-time instead of part-time. So all good things are happening. But just to a few statistics to tell you how strong the labor market is in Canada over the last 12 months. We created 1 million jobs in the country. And remember that we're about 40 million Canadians, so 1 million jobs. So that's a lot in 12 months. And since February 2020, so since pre-COVID, we're up by 500,000. So there's 500,000 more jobs now than pre-COVID. So that's a pretty strong pace that we're having right now. So that brings me to maybe interest rates and the Bank of Canada. So Bank of Canada published its financial system review this week. Lots of comments on housing, on the future of monetary policy, on household debt. So there are so many good charts. I thought, well, maybe I'll just bring interest rate charts and say verbally the other things. But interest rates are high, as you can see over the last 10 years. We've never seen such a high 2-year rate and such a high 10-year rate. So that has, of course, an impact on borrowing costs and mortgage rates. So the inflation is strong, central banks are tightening, the economy is doing well, so that means a higher cost of borrowing. And the Bank of Canada was pretty lucid in their look at the housing market, saying that the share of households with a debt to income ratio of 350% plus went up from 16% to 19%. So it's one household in 5 that has lots of debt, so that they're vulnerable. So there was a growth in that. But the most important statistic is that among the households that have mortgages, so it's about a third of Canadian households that have a mortgage. Among that third, 15% have a debt to income ratio of 450%. So the most vulnerable strata, 15% that have more than 450% debt to income ratio, and a variable rate, and an amortization period of above 25 years. So you can't be more vulnerable than that. So there's a strata of the population that's in debt. So we have a good story in Canada. The labor market is strong. Or trade, the price of commodities that we export, that's pretty strong. So we are probably be more resilient than other countries. But let's not put on pink glasses. The pandemic and the housing sector created a lot of vulnerabilities in the country. So we need to keep that in mind. And probably there's going to be some weakness in housing going forward. So prices could fall a bit. So to add on the pressure on these households. So a very interesting picture here. So what to watch next week in Canada? We'll have housing starts. In the US, we'll have the decision from the Fed. It's going to be on Wednesday afternoon, 2 p.m. Eastern time. Should have a hike of 50 basis points or 0.5%. So it's coming next week. We'll also have retail sales, housing starts, and industrial production. So that wraps it up for the week. ia.ca/economy. You can follow us there. You can subscribe to the newsletter if you haven't done so. You can follow me on Twitter, on LinkedIn, and Economy and Finance 101. There's been some new material recently, and we're already working on new materials for the summer months. So stay tuned, and there's more of this good stuff coming. So that wraps it up. Thanks, everyone, and I'll see you again next Friday with a new edition of the Weekly Economic Review.